Welcome to session 2.4, Operating Cycle Ratios. This is the last in Module 2, and then we'll go on to Module 3, even though it's in session 2. So that's something to get confused about in the future. But we're going to look at a few more ratios now, and they all have to do with current assets and current liabilities. So we're going to be looking at ratios, and that will be interesting, I think. These are the ratios we're going to cover. Notice their operating cycle, and whenever we talk about the operating cycle, that means within the year, or current assets and current liabilities. And all of these have to do with either current assets, current liabilities, accounts receivable, inventory, or accounts payable. So let's take a look at the ratios themselves. So when we have inventory, the key questions about inventory is how old is that inventory, or how long has that inventory been on the shelf? And is the inventory turning, meaning how many times a year are you stocking your shelves? So the first ratio we want to talk about is inventory turnover. And that's cost of goods sold, in other words, the inventory that you sold this year, over the average inventory. And remember, an average is the beginning of the year inventory on the balance sheet plus the end of the year inventory on the balance sheet divided by 2. In other words, about how much on average inventory did you have. Now, what that will give you is a number, and it's the number of turns a year, or the number of times you stock your shelves that year. There's a ratio that comes off of that, which is called days inventory on hand, which makes a whole lot more sense to many people. And that's to take 365 days and divide it by the inventory turnover. And that will give you the number of days your inventory stays on the shelf, or in other words, their shelf life. Now, that's the inventory piece, so that you can look at and see the quality of your inventory. I bet you want more turns, high turn, and you want the number of days on the shelf to be a smaller number of days than larger. Accounts receivable has something similar, which is really getting at the quality of your accounts receivable, or how long does it take your customers to pay. So the first one you do is accounts receivable turnover, where you take your net credit sales, and what I mean by net credit sales, those are the sales that are not cash sales, but are sales that you made to customers on account. So those credit sales divided by average accounts receivable. Beginning of the year accounts receivable plus end of the year accounts receivable divided by 2. In other words, a simple average. And that will give you the number of refresh rate of your receivables. How many times a year do you get in a new set of accounts receivable? That you would like to have a high number. Like if your accounts receivable turnover is 12, that means it's turning probably about every 30 days. Coming off of that is something called days sales, where you take 365 and divide by accounts receivable turnover, and that will give you the number of days that it takes basically from when the customer says, I want it, and you invoice them until they pay for it. So this is how long is your money tied up in customers that say they're going to pay you sometime in the future. So there's an important concept that combines these two called the operating cycle. And what the operating cycle is when you start the year or the period, you have cash. And at the end of the period, or the end of the operating cycle, you're going to have cash. But in the meantime, your cash gets used or tied up either in inventory, because you're buying things that you offer to customers to purchase, or your cash is tied up in those customers who have purchased but haven't yet given you the cash. So the operating cycle is sometimes called cash to cash, or how long does it take? How long is your cash tied up in inventory and accounts receivable? When we look at accounts payable, which is a current liability, it's looking at how long does it take you to pay your bills. In other words, how long does it take from when you get a bill to when you pay a bill? So your accounts payable turnover, you would like it to be at least 12, meaning you pay and all your bills are current 30 days or less. But they may be something different. If you deal with the federal government's accounts payable turnover, it takes them a lot longer to pay their bills. So at any rate, to get the accounts payable turnover, you take the cost of the goods sold and you divide it by the average accounts payable. Now this is assuming that you're a business that has a lot of inventory and that you finance that inventory by buying on credit. So you're buying your inventory on credit, and this then makes a lot of sense for your business. If you're a service business, this accounts payable turnover ratio won't make a lot of sense because you have no cost of goods sold. You have cost of sales, but there's no inventory. Average accounts payable is same like the others. Beginning of the year accounts payable balance plus end of the year accounts payable balance divided by 2. But what helps even more is to look at your days payable, which again is to take 365 days and divide it by the accounts payable turnover. And that will give you a number, which is the number of days it takes you from when you get that invoice until you pay that invoice. All right, so we understand the operating cycle. We also understand the accounts payable, days payable. So what we're going to do is take that operating cycle, how long your cash is tied up in inventory and accounts receivable, and from that subtract your days payable. And if you get a positive number, you have what's called a financing gap, which means you have to go out and borrow short term because the cash is not becoming cash quick enough to pay your accounts payable in a timely fashion. So you have to go out and borrow short-term credit in order to close that financing gap. But if your days payable is more days than your operating cycle, you have no gap and you're able to use basically your days payable and your operating cycle for free financing from your suppliers. So financing gap, you'll hear them talk about a lot. So here it is one more time. We want the operating cycle, which is this, minus the days payable, and that gives you also what's called the cash conversion cycle. And once again, if that operating cycle is longer than, your money is tied up longer than your accounts payable, you're going to have to go borrow. If it's less than your days payable, then you're able to self-finance and you don't have to borrow. So here's an example. This is from your book. In 2009, Coca-Cola had the following ratios. Days inventory was 75, days receivable was 40. So if I add those together, that's 115 days of an operating cycle. The days payable was 45. So our money was tied up a lot longer than I needed to pay my bills. So I have a financing gap of 70 days. So I need to go out and borrow on a short-term basis to close the gap. Here's one where we're going to be looking at computing all those different ratios. So we're going to do the current ratio, receivables turnover, days sales uncollected, inventory turnover, days inventory on hand, payables turnover, and days payable for each year. And after we do all of that, we're going to figure out if there is a financing gap. So we're going to be doing this for 2018. So this 2017 is the beginning of the year, 2018 is the end of the year. So let's see what those ratios look like. I know this is messy, but here's your ratios. Your current ratio, current assets over current liabilities, is 3. I'm going to use my highlighter. So is 3. When I do my accounts receivable turnover, notice accounts receivable turnover 8 times a year. And if I express it in terms of days, 45 days is how long it takes my customers to pay me. Looking at inventory, inventory turns 4.18 times a year, or it's on the shelf 87.3 days. When I do my payable turnover, notice payables turn 6.38 times a year, or in terms of days, 57.2 days. So, if I find the operating cycle, which is the days sales plus the days inventory, it's 132.8 days that my cash is tied up in inventory and accounts receivable. Whereas my accounts payable, I pay in about 75.6 days, or that's the gap. So because I have a gap between the operating cycle and my days payable, I have to go out and finance or acquire short-term credit for 75 days. So that's quite a bit. That's, almost over 2 months. So this is an example of how you can use these ratios for